Stocks finished the week on a high note with a good week, good market reaction to the trade deal that was officially finally signed that everybody had been anticipating for a few months this week. So I'm going to break down now the technical reaction to what was a very strong week, how bullish that was and what it means, how that impacts our expectations, how we plan around a strong trend that pretty much is negating any expectations of significant pullbacks, especially in the near term, but still be able to prepare for anything that's unanticipated that can impact that. So we're going to break that down, what to do, and show a trade idea for a stock that might not give you the signal that you think right off the bat for the trade that we're going to do. So let's go ahead and get started. Today is Friday, January the 18th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 here with the market forecast indicator like we always do. Of course, the intermediate posture long-term market sentiment is still strongly bullish as we finished the week at the high point of the week. I mean, that's about as bullish of a week as you could possibly get. In fact, if you look at give me a second, we'll look at the weekly chart here. I did want to point out here, and I got this from Dana Lyons on Twitter. If you look at the Fibonacci retracements during this bearish move that we had, we hit the highs. We came back down to this 38% retracement level there, and we bounced back up to new highs. But you notice now we are right at the 162% retracement level. So keep in mind, there's some possibility for some weakness there. We'll see if that ends up being the case, but I did want to show that to you as that stands out as we're hitting in that area right now as we speak. Now I'll show you that weekly chart. We got a cluster on the weekly chart again, so it's our third in the past however many weeks this is. Very, very strong week on the weekly chart. We are well up above the moving average. This would be the 30-week moving average, of course. Here, and we've been bullish obviously since way back over here. The green line didn't turn bullish, but keep in mind too on that, we can be bullish for a long time. I mean, look at all this bullishness that we had. I mean, we've had brief periods. We had death cross here, we had death cross here. That's what dark green shading or dark pink shading and a red line will tell you. But, so we can go a long time, and I believe where we are. I believe that this is a pretty significant low point that we hit actually later in October that we're rallying off of. And you can see, like, for example, over here from 2012 all the way up to 2015, we went almost over about 3.5 years with only light pink shading. So this started back in January of 19. So we are actually just a year into this. So, and this one over here started in March of 16, coming out of that death cross environment, and it went all the way to October of 18. So it's 2.5 years. So we're not like, we're not necessarily overextended. And January 18, to kind of give you an idea, January 18, we were already almost 2 years old on this run, and we are just barely, like I said, 1 year old here. But it is a strong week. We're strongly bullish here. We continue really to rally hard as we push up the new highs. The near-term line is strongly bullish. How many days is this now? And it's not going to drop below 50 anytime soon. So we're looking at 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 days. We're probably, and that's the end. That's the long end of the near-term range of 7 to 12 days of the near-term line being up above 50. So this is a long move as it is for a near-term run, and we're not going to drop below 50, like I said, Tuesday. Probably not Wednesday or Thursday. It's probably not next week at all because of how high it is, unless we really get a sharp drop to this 23% level within a week, like within next week. Again, you need a catalyst for that. And right now, that's why the markets are so bullish, because the market's not anticipating any particular catalyst. So it would have to be an unexpected catalyst that the market's not anticipating at all. Otherwise, some of that anticipation will be baked in. But the reason why we're strongly bullish is that there's no anticipation of any catalyst right now. That doesn't mean that we can't run out of buyers and slowly and exhale and have a pullback without a catalyst. It's just those pullbacks are slower. They're not as steep. Right? They don't drop immediately in 4 days. They just kind of grind their way down as you just run out of buyers. There's always buyers and sellers every day. When you're going up like this, the buyers always overwhelm. And so once the buyers stop overwhelming and once they start underwhelming the sellers, then we get the slow grind pullbacks, which is fine. Before we had this either, we go up every day or we have extreme pullbacks environment. That's how the markets worked. You just went up, you ran out of buyers, the buyers started underwhelming because there's always buyers and sellers. They started underwhelming and we had pullbacks. We had nice, slow, small moves, small range pullbacks. And that's what brought the near-term lines and eventually intermediate lines down to levels like this. And we rolled up and then we got to the point where buyers were willing to re-engage at better price points and we went up to new highs. And so we'll see if that ends up being the case here, again, lacking the catalyst. And you can see I've got the Fibonacci lines drawn. Let's see where we could and if and when we ever do get the intermediate below 50, because we will at some point, where the support levels will be as we do that. Take a quick look at the Russell 2000. You can see not as bullish as the S&P was. We actually started up higher and then dropped throughout the day. That kept the near-term line down. The intermediate line it got back up above the market sentiment. They're both above 80, so that's okay. I mean, if it fluctuates up and down, that's okay as long as they're both above 80. But you can see the near-term line doesn't have the same run. It's only about 5 days instead of 12 because of that pullback here. And this is actually an intermediate confirmation signal. I just highly doubt it will play out because the near-term line hasn't dropped. Usually they play out better, like this one, for example, where when actually you had the intermediate line below 82. But if the intermediate line was above 80 and you had the small dip below 20 on the intermediate line, with the near-term line also below 50, those play out. That kind of intermediate confirmation plays out better than this one. By definition, it is an intermediate line, and we might get another day or two of buying out of it because we're only 5 days into this near-term run. But remember, we're actually 12 days into it when you're looking at the broad market as a whole. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when these videos are posted. Hit the thumbs up icon down below the video too. That tells us that you want us to do the video again next week, that you want us to keep doing it. If you don't like these videos, then you don't have to click anything. Also comment, what did you get out of the video? We always like to hear if you got anything and what it was and what value you're getting out of these. Join our website at marketscholars.com. You can do that for free by clicking that link up there in the top right corner of your screen for content that we provide for our free subscribers. Follow me on Twitter for more content in between these videos from day to day, and join our Market Outlook Facebook group that we've created. But if you're watching this on our website here, we have our video. We invite you to check out these other things on this page as well. Check out our Market Outlook live videos that we do every day at 3:30 Eastern time, or every day that I do these Market Outlooks, so we can manage our active trades all the way to the time we close them. That's a very popular feature we get asked about a lot. Can you talk about some of the trade ideas that you mentioned in previous videos and see where they're at and how to manage them? Well, I do that every time we do one of these videos, these live videos. That's the point. We also put on today's trade idea before the market closes. So check that out. That comes with your monthly plus subscription, as well as the premium subscription as well. With that monthly plus subscription, we also give you access to all 8 of our trading rooms, and you can check those out over here on the right. Engage with us on social media. Click this heart right here. That opens up this window. You can like today's Market Outlook tweet there. Also hit this thumbs up. And you can like our Facebook post as well. Again, the more you engage with us on those platforms, the more you'll make sure that you get all of our content on those platforms, because they'll promote the stuff that in your timelines that you engage with the most. So we try to make that very easy for you here. All right, now let's check out some of these other charts here. Let's look at the long-term chart. We'll come back to Intuit here in a minute. But look at that candle. I mean, that's an extremely bullish candle for S&P 500. We're closing above last week's high. I mean, like I said, I mean, if it's going to take a while for this pullback to emerge, if and when it does, Obviously it will, but it's not going to happen anytime soon unless there's, like I said, an unexpected catalyst out there the market's just not anticipating because of how bullish we. I mean, look, we have 1, 2, 3, 4, 5, 6, 7, 8, 10, 11, 12, 13, 14 weeks. We're well above the 50-day moving average. According to the PPO here, the 50-day moving average is well above the 50-day moving average is well above the 200-day moving average, which is what this measures. In fact, the 50-day moving average is 6% above, 6.25%. And you can see this isn't extreme. We've been higher than this before, and just because we get to these levels doesn't necessarily mean, like you can see here, when we started this bullish move, we got to these levels and we didn't tank. We actually kept going up for another couple of years. So now we are grinding, and that's expected. And you can see same thing over here. We came down to the 200 a little bit, but then we went up for a few more years. So just because we are hitting these levels doesn't necessarily mean that we have to do like 2011, where there was a pretty decent catalyst that sparked that kind of move. That was obviously very temporary because we just kept going up after that. So so that's where we're at right now. You can see we're just not that euphoric. It doesn't look euphoric here when you're on a log scale. We've got plenty of opportunity to continue to make a move. I mean, we look like this back here too, and we went up for another year and a half, for an example. So that's what the long-term chart looks like. Let's take a look at the intermediate chart and look at the 3 green arrows for the S&P. Let's just go to SPX here first. And you can see that we got 3 green arrows. We continued, and we're not even close to that moving average. We're well up above there. You go back to SPY, and you see that today's volume, this expiration volume on SPY was really strong. It's some potentially kind of a blow-off top type move, especially when you look at the gap here. It's one thing to get a lot of volume when you're breaking through a major resistance. It's another thing to get a lot of volume when you're at the end of a move. And look at a lot of that volume you see coming at the very end. So there's that, there's a couple of gaps here that we haven't filled in. And these aren't breakaway gaps. We're not breaking through any significant levels here. And today's was a little bit smaller, but you get the idea. And so, with the expectation that you fill in common gaps, and these are very likely common gaps, then, a pullback here on a near-term basis, at least bringing the near-term line down, the blue line below 50 to 327.5, is definitely within the cards next week. Again, it might not happen Tuesday, it might not happen Wednesday, but through the process of next week, don't be surprised if we get, and that wouldn't be that big of a deal. You can see how high we are, and look at the range, and again, this is going to pop up here to that low point right there for about another week. So it's going to be about about 320.15, I think. So it's another quarter point higher. But we're 12 points. Was the range. We're starting to stretch the rubber band a little bit. So and we're so far, like our point of control is so low right now, and we're so far above not only the point of control but also the value area for the 4 weeks. We've really stretched out the rubber band. In a 4-week period, you generally for the most part stay within the value area. But the fact that we're stretched out so far up above it and approaching that 5% mark, a gap between the high and the low for the 4-week range, again, and the fact that you have these common gaps, again, don't be surprised. It doesn't necessarily mean the intermediate line is going to pull below 50, but at least bring in the near-term line. This will most likely bring the near-term line eventually below 50, which is, like I said, you never go. The longest I've seen us go the near-term line without dropping below 50 is like 20 days, 20 plus days. We're obviously not to those levels yet right now, but we are at the end of its normal range, the long end of its normal range. So the odds are never 100%, but the odds are relatively high for all these different factors that sometime next week we'll fill in these gaps, potentially move down to this 327.5 level and bring that near-term line down and give us a new near-term low point. We very likely will bounce off of that, and then we'll see if we get a new near-term high and another 7 to 12-day run out of it. We saw the volume. Let's go. Actually, I wanted to show you the 3 green arrows here on this chart really quick. Again, no intermediate pullback until we start to converge, right? And we're not anywhere close to converging right now. The convergence, remember, is when this blue line here starts dropping. So it's still rising. It's at its highest level of this whole run, which is Again, that's where the comparisons to January of 18. It's rare for the MACD to diverge to its highest point late, when you've been in this run for a while. So that doesn't necessarily mean that we're euphoric, because we're not, at least especially in a long-term basis, because we were euphoric on a long-term basis in January 18. So we might be a little euphoric in the short term, according to some of this, and maybe a little intermediate, but not in the long term at all. Not even close to what January 18 looked like. Buyers are in control, so that's why you don't want to short that, even if we do expect a near-term pullback. When you got buyers in control, according to stochastics, it's kind of hard to do some heavy shorting. It's okay to reduce your positive deltas a little bit with some bearish trades and small bearish trades and relatively high probability if you can find them. But you don't want to be aggressively shorting when buyers are in control here. And then finally, let's take a look. Let's go back to, what was it? This chart here, the 3 green arrow. As I saw, the volume was 95 million. The trading range, we have to include that small gap, so 330.92 to 330.85. Actually, we filled in the gap there on the on SPY, it looks like. From the close, 330.92 to 330.85. So the range today is 1.33 points. Very, very, for as much volume as we got, that was a very small range. You put that into, this chart here, and you can see, the trading range well below the average. The volume was up here, so you don't want a lot of days like that with that much volume. That's why I'm a little wondering if a little bit of a blow off there, because that was well above the average. We haven't had that much volume in a while. But I'm not too with the ATR to price ratio way down below 1. I'm not too concerned at all about any significant pullbacks here. If anything, right now, next week, if we get anything, it'd just be a short, small, near term. But again, you still trade bullishly, right? As you'll see with our trade idea later today. I also wanted to show this chart here. Again, this is a reminder how long we've been going without a 1% move. And actually, you have to go to SPY here. This is how long SPY we've gone this whole time without a 1% move to the upside or the downside. So that typically runs its course when it's been this long. So that's why you reduce your risk. You have to follow the trend. So if you're not bullish, you're missing out. And if you're not still bullish, even going into next week, you're missing out on what could be a very strong week next week too, for all we know, because that's the trend. But it doesn't mean you have to be as bullish now as you were over here when we were just coming off of this intermediate low point and turning higher. As you've noticed, and especially in my directional option strategies class, we're still pretty decently bullish, but we're definitely a lot less bullish than we were over here. We've been able to reduce deltas, make some trades, keep our newer trades smaller, and our deltas are a lot smaller now. They're still pretty strongly bullish, so we're still doing pretty well, but we're not nearly as bullish as we have been. So to summarize again, our technical outlook: strong bullish trends, maturing trends, definitely signs for reducing risk, right? We're not, definitely you don't want to have more risk now, more bullish risk now than you did 2 months ago. If you do, then you're, at some point in time, you're going to be toasted. So you should be bullish, but you should be less bullish than you were a couple of months ago, progressively less bullish, because there are plenty of signs of maturity and cropping up some signs of weakness heading into even next week alone, especially on a near-term basis. So it doesn't mean that we will, but it means what it does mean is that you should be prepared just in case. Like I said, and it doesn't mean that you shouldn't be bullish. You should be less bullish than you were, say, in November. Right? If you're more bullish now than you were in November, then at some point in time, that's why people get so skittish on pullbacks, because they get progressively more bullish as the intermediate run matures instead of getting progressively less bullish. You should be more bullish when you're at those lows and you're bouncing. You should be more aggressive, good reward risk ratios, and small risk and more aggressive. But usually it's the other way around, and so that's why I'm trying to teach you to kind of get in that correct mode of thinking. So what do you think? Do you agree or disagree with that technical assessment? There's a link right there. It obviously, as always, opens up a poll. Hit that, either agree or disagree. If you click disagree, as always, comment down below. I don't pretend to be 100, have 100% of people agree with what I think or what I'm showing here. So if you're one of those that doesn't, you're either more bullish or more bearish than I am, then share what you're looking at with our community of Market Outlook viewers here, market scholars, down in the comment section below. All right, now let's break down the week that was. Obviously, the big news of the week was trade news, and we had a lot of economic data. We'll take a look at here in just a second, but let's take a look at. Let's do a custom time frame here of how the week ended up here from an asset class standpoint. You can see real estate had a nice good run, and small caps had a good week this week compared to large caps. So that's a good sign for risk appetite to see small caps leading the way high. That hasn't always been the case. You can see emerging markets and developed markets kind of matching each other but lagging behind, partly because a little bit of the stronger dollar that we had this week. On the other end of the spectrum, gold and long-term bonds were down, but only a little bit. Crude oil was down, so that's why we weren't really totally risk on here, because crude oil is not kind of matching that market move. If I were to go 1, 2, 3, let's go 4 weeks here. So 1, 2, 3, 4, and take a look at that, and let's go to a 30-minute. So here's the 4 week, and you can see still in that 4 week period. Remember how I said that the S&P was kind of stretching out its range? Look how strong gold has been, and look how weak the dollar has been. So let's take a look at some of those different asset classes and how they are going into next week, especially the dollar, because the dollar is a main driver for this idea. And if for those of you who are market scholars, especially for anybody who's our market scholars, my technical analysis class yesterday, we focused on how to use these charts to determine whether we're in an inflationary period or a deflationary period. So there was a surprising result from last year that you might not have anticipated, and I show you why, and I show you how to see how we're shifting here this year, going into 2020, and what to watch for. So I break all that down. But the dollar, and we talk about what it means, like how we'll react to those changes. The dollar is a big tipping point in that, and you can see. Look at the dollar today. That's a bullish market forecast pattern. We got dark green shading and a green line now. And we were kind of using this peak here to roll over from. In fact, on what would that be, Wednesday, we closed below the low of the high day, the low of the 4 high days, right? If you count all 4 of those as the high day, because they're all kind of the same chart. We closed below all 4 of those days, the lows of those 4 days. So it looked like we were reversing back down again. Pink shading, red line. The dollar was reversing, but then after 2 days later, boom, we break up above those highs and get a bullish market forecast pattern. If you look at the weekly chart for the S&P, you can see light green shading again, the near-term line coming off of a bullish low point, even though it was a lower low. The near-term line didn't get in the reversal zone, and it's back above 80. So the dollar is kind of trying to figure out its role here, and that's going to be a big determinant as to how we anticipate different asset classes to perform this coming year in 2020. Let's take a look at gold. Remember, gold had that nice, good 4 week period. There's that 4 week run. We're on the light pink shading though, nowhere close to flirting with that moving average, so that's a good sign. But you notice that long upper shadow, we can't get above this high point. If that dollar doesn't roll over, it's going to be hard for gold. So you can see, gold's got this little bit of a resistance level here that we can't quite get through. The top end of this volume node that we had over here. Break through that, obviously it's going to coincide with a bearish move in the dollar. But if the dollar can't break through, it's going to be pressure. So kind of looking at these charts in conjunction with each other will help us know. And gold's got some pretty good gains. I would venture to guess gold's going to have, the Bollinger Band width is high, it's dropping, which means gold's going to flatten out a little bit and let those Bollinger Bands kind of move together. The other thing too to keep in mind in terms of risk appetite and inflationary expectations or not is to watch crude oil. And you can see crude oil, has pulled back in this past week and a half. But you notice it's pulled back to very strong support levels. So don't anticipate more of a pullback. But also, we are in strong levels of volume. It's not going to be easy for it to bounce either. But you need it to. You need it to bounce. You need it to hold the breakouts, and it's been unable to both times. To really, this was the Saudi oil fields. This was the Iran issues, and neither time was gold or crude oil, able to hold that breakout above this level, this 23% retracement level. If I go back, you can see this bullish move we had, the pullback to the bottom of the retracement of the main retracement mode. But again, you don't really get going in terms of getting to new highs until you break back up above 23. And both times we've broken back above 23, it's been unable to really get going. But we pulled back down to the 38. This time held that for support because that's where all the support is, and on a volume level as well. And now we'll see if we can make another run. This time was the end of a run from down here. If we don't have to make all that run to get to that point, we have more of a chance for it to hold. But it's lots of volume, so it's not going to be easy, right? It's going to be a grind higher. That's why this risk move is not really getting going here. The other asset class to kind of pay attention to is the yields, right, on bond yields. If you take a look at the 10-year yield here, you can see it's pretty flat. It's not really going anywhere. In fact, if you look at the Ichimoku Cloud trend strength indicators for it, look how noisy. We haven't been above 50 for months. It's been a very, very short trend. Now, they've all been kind of bullish moves, and we are above the cloud, so there is a bullish bias. We just can't get going. There's no, and especially on the weekly chart, we had this big bearish trend, and now we're pretty noisy. It's kind of hard to transition from an extreme bearish move. If you look here, let's go back and give you some context. When you go from an extreme bearish move like this right here, where you had a long term, and that wasn't nearly the same, but you notice it was hard we didn't go to an extreme bullish move off of that. It's hard to get going, and here we did go from a strong bullish to a strong bearish, but you can see the distinction. It's not quite the same. Here's another where we went strongly bullish, and we weren't able to really get going with a strong bullish trend, not until we had that second leg lower. Same thing here. We had a big move down on the bearishness, but then we really couldn't get going with a good strong bullish move. It was choppy. So we're going to be choppy. We're going to be choppy here for a while, especially on the weekly chart being below the cloud still. So until we can get through, and if you look for that context again, and here, let's go back. I don't think I was on weekly. There we go. If you go back to some of these, you can see it needs to get through that cloud and stay above that cloud for us to get going. And you can see kind of some of these levels, how we weren't really able to get through that cloud, and that's one of the reasons for the choppiness. So we still kind of get through it, and it's going to be a while before we get through that cloud, before we can really start a bullish trend in the same direction as that. So, again, that's going to be a mark. This is one of the factors when you're looking at inflationary and deflationary expectations, and obviously being below the cloud in such a bearish trend, you can see why 2019 might not be what you thought it was, simply by looking at S&P 500 year-to-date returns. Big topic that I explored in detail yet in yesterday's class. All right, so from a sector standpoint, you can see again, kind of risk on, kind of risk off. Real estate's up here, utilities are up here, and it's not like bonds were up either. And so strong move in some of these interest rate sensitive areas. And then you see on the other end of the spectrum, of course, with crude oil down this week, energy stocks were down. But they had a really good a few weeks before that, so not surprising they give back some of their gains. You can see healthcare and financials lagging behind. They've had some good gains here recently. Consumer stocks still lagging. So again, we're not really euphoric until you get that other cyclical area. These consumer stocks starting to outperform too, and start making their way higher. You can see communication services. Remember, there's an element to communication services that fits with technology, like Facebook, like Netflix, like Google. But there's also an element of communication services that fits with these interest rate sensitive areas, with those high yielding utility stocks. It's really kind of matching, those areas too. And so interesting to see these interest rate sensitive stocks. Now keep in mind that they've had a rough few months, right? Because they were so bullish previously. They were so bullish previously here that they've pulled back while everything else has taken off. And so they've kind of, on a relative basis, they've been really weak. And so they've had a little bit of a bounce. And I think that's just more of an oversold relative strength bounce than it is oh no, we're about to get really bearish type bounce. Because again, you don't see, a lagging sign from a sector rotation standpoint that signals the end of a long-term move is energy and materials really outperforming. And obviously that's not anywhere close to being the case. All right, so for our trade idea of the day, I did want to take a look at Intuit, if you saw it earlier. Like I said, we've already put this trade on in our Market Outlook live session at 3:30 Eastern Time. So it's already been placed before the market closed. Some of you might look at it here going into next week. The thing that stood out to me was this cluster. It's a little counterintuitive because you think, oh, the cluster means that we're overbought. And it is an overbought cluster, but it doesn't mean that's going to drop. It might drop in the short term, and I don't really care if it pulls back here next week, and you might get better pricing. Who knows? But the reality is that we just barely started an intermediate run, and we got a cluster at the beginning of the intermediate run. And as I mentioned to you before, getting clusters early typically solidifies the move. That eventually becomes more of a multi-month intermediate run. Let's see. I don't know if there's any examples specifically on here, and we don't. The more of the clusters came later on the stock. But when you look at like SPX and you see, okay, when you get an early cluster, that solidifies the intermediate run. And here you got a late cluster, and you're starting to get some late clusters over here too. But we like early clusters within that first month of a run. That suggests that we'll probably get like a multi-month, 2, 3, and especially on individual stocks, even more than that. Of an intermediate run. So here we are just barely getting one. Very, very good sign that we'll get that type of a move going forward from here as the intermediate line. You can see when the intermediate line first crosses above 80, that's the ideal scenario to get one. We didn't quite get one over here, obviously. We came close at this level, and we kept going up from there. So obviously nothing's guaranteed, but it's a very good pattern. And if you take a look at its Hakunashi candle too, nice little reversal pattern. We've had a pullback to the 200-day moving average. PPO came down, it's rolling back up, and we got a reversal Hakunashi candle this week, closing above both of these highs. So, and remember, the Hakunashi close is an average of 4 prices, so it's a very good sign to get that. If you take a look at the 3 green arrows for Intuit, you'll see obviously you have 3 green arrows, and today a little spike in volume. So good sign, good from that perspective, a good sign. If you take a look at its DMI and DMI, the positive's already above, but you notice that we are now starting to cross above 20. So the ADX is crossing above 20. That's going to create some light pink shade, light green shading here, and ultimately the hope is that it leads to an extended run of dark green shading. And if you look at its the Ichimoku Cloud, that's what I wanted to look at. The goal is to get a strong trend, which we're very close to getting above 5, and we're already above 80. That leads to an extended strong trend, obviously already above the cloud, and very strong pattern here. And if you take a look at its Bollinger Bands, we are above the value area now. Today's breakout solidified the breakout above the value area, and very little, the path of least resistance from a volume standpoint is to the upside. Obviously a lot of volume to the downside, and we have a stop order there anyway, but very little volume to the upside. So path of least resistance will suck us up. But hopefully, I mean, that's the intention based on these technical patterns. Whether it does or not, nothing's ever 100%. But that's what we're looking for. So we'll look to buy, in this case, here, let me just close it so you can see it better. You look to buy the at-the-money strike. It is an expensive option because it's expensive stock. So we'll put our stop order at 50% of that. So ultimately our risk on the trade is, and here let me get rid of, this is the trade that we ultimately put through, buying the 280 at the money in April, so it gives us time. We put ultimately, you can see I got 1,350 at risk, but remember we have a stop order, so we're putting half of that at risk, which is what, 700, and I don't know what that ends up being. My math on a Saturday morning, and so my brain like turns off on Friday. So $675. That's what I wanted to say. And if it does get to the 1 standard deviation move by April expiration, we're looking at a $29,000-$3,000 reward. So about a 4 or 5 to 1 risk reward ratio if it just makes a 1 standard deviation move. Obviously, if it makes more than a 1 standard deviation move, then we have, more return to member path of least resistance. Now I'm not anticipating a 2 standard deviation move, but you can see what kind of what it can play, what kind of play out. I mean, even just from the 2 to anywhere between 3,000 and 7,000, anywhere in there would just be that much better of a reward risk ratio. So small risk. If we do hit our stop order, we hit our it's in there. So if we do trigger our stop order, we'll take a $600 loss, but good potential reward and opportunity for a move based on those technical signs. All right, so that does this for today. You've heard from me now. Now I want to hear from you. Use that link right there. It's popping out to our Market Outlook forum on marketscholars.com. Open up any new thread that you want with any questions or comments you have about today's video, or for that matter, for anything we didn't discuss in today's video that pertains obviously to this topic. Let's keep this conversation going. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment on our video. Follow me on Twitter for more content in between videos, and join our community at marketscholars.com as well as our Facebook group that we've created. Have a great rest of your weekend, everybody, and we'll see you all on Tuesday.